That's the picture from the market side. Unfortunately, the market's still not getting enough support from the macros, although it has gained considerably since the start of this year, largely on the back of fund flows. But the macro picture still worrying, at least if you go by today's data point, which was the industrial production numbers. And again, just as a reminder, you'd seen a steep drop compared to November and December, taking industrial production growth down to a 1.8% tick. And over a longer period of time, as you can see, this fiscal growth has been pretty discouraging. Joining us to talk about what needs to be done from here on to revive the industry is Mr. Ankit Mignani, Deputy Managing Director at Uttam Galva Steel. Also with us, Mr. A. Mahendran, MD of GCPL, that's Godrej Consumer Products Limited. Very good afternoon to both of you. Thanks for joining us. Mr. Mahendran, let me start with you. So far this year, we've banked on the consumption side of the economy. We've known that the investment side of the economy is in a mess, but the consumption side has held up nicely. But it now looks like, that part also at least is moderating. Rate hikes, general slowdown starting to bite into the mood of the consumer?
Yes, I would like to confirm that the mood of the consumer, as far as the particularly FMCG the sector, is pretty. I wouldn't say that many people are referring to slowdown, etc., etc. But as far as we are concerned, no, we don't see that. And right now, the consumer non-durable IIP data which has come today also confirms that it's very healthy.
So you're saying, Mr. Mahendran, if I can just stay with you, that so if you split it, say on the FMCG side, the worry was that high inflation will eat into growth in the FMCG sector, high inflation will dent consumer sentiment. On the durable side, it was an interest rate concern. But somehow, consumers seem to be beating both those?
Yes, that's what I'm saying. Particularly, I can definitely vouch for FMCG sector.
Ankit, unfortunately, I suppose from your industry standpoint, things are not looking that rosy. I mean, you look at the core sectors and they're bound to feel the pinch from a slowing investment cycle. Is that continuing? Has anything changed in the last couple of months?
We are seeing a slight uptick, but that's more seasonal in nature. I don't think the uptick is sustainable. You will see better numbers when you look at the Jan, Feb, March compared to the December numbers. But again, that would be a misleading factor because the underlying fundamentals have not changed. We still have high interest rates. The sharp drop in the rupee will hurt consumption. The underlying assumptions are not that significantly different from last quarter. However, you will see a seasonal uptick in the first quarter of the calendar year.
But just longer term, Ankit, I mean, your sector links into real estate, it links into infrastructure. Is there any reason to believe that perhaps even next year you could see a significant pickup? Because, after all, those pipelines are long gestation pipelines. They start to, projects start to come on the table. They start to get put in place. Is there any sort of pickup in activity yet? Or are we looking at now perhaps 2 years of fairly sluggish investment growth and hence core sector growth?
Ira, quite frankly, the triggers have not crystallized yet. You see, why is infrastructure development down? It's a function of high interest rates. It's a function of poor global economic conditions, and a major function is political policy uncertainty. And until these issues are resolved, we cannot see infrastructure spending coming back. We cannot see capital goods spending coming back. If you're going to ban all the mining in Karnataka, no one's going to put up a steel plant there. So obviously that is one example of where you see the drop in capital goods, for example. But the underlying triggers are still foggy. We don't have transparency in what policies are going to be like, how things are going to materialize, when interest rates will start moderating. The fact is that interest rates are at 15% and the rupee is still falling, which is counterintuitive. So we're having a double whammy on that as well. So the actual macro fundamental triggers are not yet clear to determine whether demand will come back this year, next year, after 2 years, after 3 years. Because we need to have a trigger to do that.
Well, that's a very important point. And Mr. Mahendran, I mean, yes, consumers have been relatively insulated from, all of the policy chaos, but yet, as a larger industrial aspect, that's a very valid point that you don't have the triggers. What is the trigger that's going to push the economy back towards 8.5% kind of growth? We're not even talking about that, but that's what we need to aspire towards at least.
Yeah, but what I'm saying is from an FMCG consumer non-durable consumer sector perspective, a GDP growth rate of even 6.7% is from a consumption angle of this sector is pretty good. And of course, if it is at 8.5% GDP growth rate, could be good for capital goods or other sectors. But if you look at it, consumption where categories are utility-oriented categories and daily consumption as per our sector is concerned. So we are pretty insulated that way.
But sir, I mean that insulation, do you think it will continue? Because at the end of the day, if you look at it longer term, what has driven consumption, even at say at the FMCG level, it's been rising per capita income, it's been relative sort of prosperity in the rural hinterlands. All of that, doesn't it depend on broader economic progress and prosperity in the country?
Yes, but there's one point I want to say that there's a big shift is happening the last 3 years in terms of branded packaged goods growth rate, as well as the urban FMCG players are moving to the rural India. So to that extent, whatever the reporting we are doing today is on branded, what we call the organized sector. That's growing very well, eating into the unorganized.
Ankit, I guess at a time like this, maybe companies like yours hope they had more of an exposure on the consumer side rather than on the investment side. But I want to talk a little bit in the context of, sort of policy measures. We are running up into a budget, etc. Do you suspect that there's much you can do just in terms of budget items, etc., to try and revive the industry? Or is it more a mood-driven thing? If you have a decent budget, you have interest rate come down, mood picks up globally, slowly things will start to revive?
Well, first of all, I'd like to address the issue on the consumer side. We have a very high exposure on consumer demand because we supply to the auto industry, we supply to two-wheelers, we supply to white goods, appliances, we supply to construction in the rural segments, which is not necessarily a derivative of interest rate demand. Now, while we are seeing the rural segment do fairly well, the other segments, although the volumes are increasing, it is not increasing at the same rate it should be, which is why everyone's feeling the pinch, because everyone had forecasted a much higher growth rate, and that is not being achieved. That being said, we don't expect the budget to really affect things in a drastic way, because we're not expecting any major policy changes in terms of what they can do to stimulate demand. The weapons they have at their disposal are fairly limited at this point. Again, with all the political uncertainty going around, whether they choose to use those weapons or not is a big question mark. We don't have clarity on what the stand of the government is going to be. And unless there are some major triggers to reverse the process that is currently under play, we don't see any change in the situation this year.
Mr. Mahendran, just as a last word to you, what do you think needs to be done to revive the broader economy? I know you've maintained that the FMCG sector is not taking the brunt of it, which is all well and fine, but the broader economy is certainly not looking rosy. Do you think there's anything specific that needs to be done to revive things?
Yes, certainly what we would expect is in the budgets is particularly the exemption level from the direct taxation level, etc. Some correction happens. It will definitely help the per capita income, what you call the disposable income should grow a little bit more. So that would be definitely a better trigger from our point of view.
All right, we'll leave it at that, Mr. Mahendran. Ankit Miglani, thanks so much for joining us on this big picture discussion, and thanks for your comments on what the environment is looking like. Actually, it's a split view. Ankit very clearly saying that things are not picking up, and as he very well clarified at the end, they link into not just infrastructure, real estate, but also into auto sector, etc. So consumer demand-related segment, and they are seeing sluggishness continue. From an FMCG point of view, which is what Mr. Mahendran was talking about, more or less, things seem relatively okay. The markets, before we close off power lunch, you've got about a 1% cut on the markets.